Commonwealth Bank's CEO has predicted that the Australian economy is going to shrink as interest rates bite, and has also said there's going to be a contraction, but no recession. Let's have a look and see what's actually going on. Starting off on the top, we see that the Chief Executive Officer, Matt Comyn, told the ABC recently that bank data shows that household spending has begun to drop with the recent interest rates rise starting to take bite. He also said that the early post immediate rate rise, they're seeing the data of a downturn in spending across the customer base in both debits and credits. He also said that it's more pronounced with customers that have home loans, and he'd expect that that will continue to go through as rates continue to rise. Matt Comyn expects that household spending will continue to go down, and as a result, the economy will start to shrink later this year. And he mentioned that those increases in the cash rate are going to have and continue to have quite a pronounced effect on the economy. He said this: we think that it will cause a contraction in the overall remainder of the year. And he added that CBA didn't expect Australia to fall into a recession, and frequently the recession is defined as 2 consecutive quarters of negative growth in the economy through a gross domestic productivity. He also said that there's a certain risk of inflation that if it wasn't brought under control quite rapidly, that if it got out of hand, it would have further impacts. And looking at the early stages of stress, that we're not seeing that things are out of control yet. He's optimistic about the Australian economy, less optimistic about the global economic outlook. He said that he believed the Australian economy is in a much better position compared to the UK, US, and Europe, where they foresee there might be a recession over there. He's also mentioned that borrowers are very well placed. We can see here with household liquidity levels, they were at an all-time high. When the pandemic happened, liquidity levels were massive. They talk about the data that shows the liquidity buffers, as we can see here, the medium and mean liquidity buffers and ratios. And the main thing that we want to look at is the amount of buffer based on their mortgage. So in terms of liquidity, we can see investors having 12 plus months of income to cover mortgage repayments, and a large number of owner occupiers having less than 1 month, and then followed by 2 to 3 months, and so on and so forth. So this liquidity ratio is something that the banks are eagerly watching, and the Reserve Bank is certainly taking a very keen eye on. And the CBA expressed their confidence that customers will be able to keep up their loan repayments in the face of rapidly rising interest rates and a slowing economy. Matt also said most of the bank's customers were very well placed. Now, the economy is in a strong position with full employment. In particular, we do recognize that there is some uncertainty, and the rising rate environment does put additional stress on customers. We know unemployment is at an all-time low, and that definitely gives the Reserve Bank very much a confidence that people are well placed to find jobs, and they're not going to be in a position, if they are willing to participate in the workforce, that they can meet their commitments. But we will still see marginal borrowers affected by these interest rate rises. I think the CommBank's looking at it as a holistic point of view, and CBA actually said 2/3 of their customers had direct debits that were being made above their minimum required repayments at current levels of interest rates, and this number would drop to about 25% if the cash rate continued to rise above the forecast that CBA has put at 2.6%. Now, the bank noted that 1/3 of its mortgage customers were at least 2 years ahead on their repayments, with around half at least 3 months on their repayments. That's a huge number to be 2 years ahead on their repayments. I'd love to see their data around that, how they get that, because that is a massive amount of people that are very much ahead on their mortgages and their commitments there. Definitely good to see that these borrowers have buffer and a bit of padding if things continue to rise or they lost employment, they can meet their commitments. It was noted that 22% only had just enough to meet their repayments at the time, and a further 15% had less than 1 month ahead on their mortgage repayments. Now, the CBA economists are tipping home prices to fall 15% from peak to trough, and this is largely based on the interest rates increasing, which has reduced borrowing power. So definitely something there that they're sort of predicting that rates will keep softening the housing market. And whilst households can only borrow about the same or less they could in 2016, we're also seeing this impact investors as well, with capacity being reduced. So definitely interesting times there. We can see CBA quite optimistic about the outlook there. They've got data to suggest that borrowers have a bit of cash saved up to cover them as rates continue to rise. And CBA having also come out a little bit earlier in the year saying they tipped interest rates to hit that 2.6% before the Reserve Bank might need to actually go backwards. Here at Hunter Galloway, we're mortgage brokers. We're based in Australia. We deal with people Australia-wide. So if you're living in Brisbane, Adelaide, Melbourne, Sydney, we can definitely help. If you're looking at getting a home loan, getting in the first home for the first time, or looking at assistance to buy an investment or refinance, consolidate debt, give us a call on 1300 088 065. There's zero cost for our service. We take care of all the details. Visit our website, fill in a contact form, huntergalloway.com.au. And guys, leave a comment below. Tell us what you thought today. If you have a question and you'd like us to answer it, definitely happy to run it past online here, and we can go through it. So thanks, guys, and we'll see you again soon.